Kelsey Roberts, and the reason that I made this video is because I believe that America will be in better financial shape when more American households are in better financial shape. I believe a lot of people who aren't in good financial shape just don't know how to thrive financially, and I believe that they deserve it. I also believe that this information should be free and easily accessible. So in the last video, we talked about the second whammy. I promised a triple whammy. The first whammy was using the traditional TSP to reduce your gross tax and not pay as much in taxes at the end of the year. And then the second whammy was the retirement savings credit and actually reducing your taxes close to or to zero, and then getting a refund of your child tax credit and your earned income credit and all of that. What I want to talk about now is the possibility of tax-free income for life, or at least part of life. I mean, it's possible to have tax-free income for life, just not really realistic, but it's possible, especially in retirement. So it is actually realistic. I say it's not realistic, but it is realistic to do this. And again, this is not cheating the system. It's not cheating on your taxes. It is kind of hacking the system. It is gaming the system. But it's designed to work this way because the federal government knows that it's actually cheaper to subsidize your retirement, which is what this winds up doing, subsidizing your retirements and actually subsidizing your income. It's cheaper to do that now than it will be to subsidize your life later on after you retire. I mean, we all know the way Social Security is going. Even though we're still paying into Social Security, we know it's not something that we can really depend on, and even if it's still going to be there, it's not going to be enough to sustain us. So it's cheaper for the government to give us a little bit of money now than a lot of money later. It just works out that way. So the system is designed to do this, and I'm showing you how to use it. So first whammy, not pay so much taxes. Second whammy, possibly get our taxes down to zero. Third whammy, tax-free income. So if you notice, if you've been watching my videos, I have tweaked this a lot, and I'm going to go and apologize ahead of time. I put in some formulas that I've been using the simple add these numbers formulas and multiply this by this, divide and percentage and stuff like that. I actually had to throw some logic formulas into here, and I'll show them to you just so you see. This formula is an if formula, all right, because the retirement savings credit is a conditional credit. All right, it's conditional on if you're adjusted, and we're talking about Snuffy. He's single. If Snuffy's income isn't more than 18,000, his AGI isn't more than 18,000, then he gets 50% back. But if it's above 18,000 from this to this, then he's only going to get 20%, and if it's above this, then he's only going to get 10%, and if it's above this, then he's not going to get any. Okay, so I had to throw some logic in there, and I'll show you the formula. There it is. If this is greater than this, then this. Okay, all right, I had to do that to show you how all this works. And again, pause the video, go back and look at that formula. There's a couple more in here. I threw some in here just so I don't have to break out the calculator every time and figure out what this is. So if his income is above 10% or above 9,075, which is the 10% margin, then it's going to calculate automatically. And if it's above 9,075, what's the 15% on the difference? So hopefully, if you've been keeping up with my videos, if you're just jumping into this one, I'm probably not making a lot of sense to you, and you're probably freaking out. I'm sorry. Go back and watch some of the previous ones. I do all this from the beginning, and as I said, you don't have to be an Excel guru to do this. This is actually pretty simple Excel stuff, and it's easy to learn how to do if you think it through. And I'll just talk you through this one, and then we'll get on with it. Okay, if D4, which is D1, 2, 3, 4, if your AGI, right, is greater than or equal to 9,075, then show 907.50, which is the maximum 10% margin. Okay, if it's less than or otherwise, okay, if it's not greater than or equal to, then it's less than. So otherwise, show me what is in here times 10%. So if this is above the 10% bracket, it's going to show me the maximum 10% bracket. If it's less than the 10% bracket, it's going to show me 10% of that. All right, and the same thing's going on here. So there you go. All right, and I did that so you can see what happens here. Now this is Snuffy, and you probably also noticed if you've been keeping up that I changed these numbers. All right, this is 2735 when we're going to assume Snuffy has been in for a couple of years. You know, before he was at 3 and he was in E4. Well, let's say he makes E5 and he stays in. He's in at 6. You know, he's on his second term. So he's making 2735 a month, and to simplify things, he just made it for the whole year. All right, 2735. So his income, his base pay is 32,820. All right, that's way to go. You made NCO. So the gross income is there. All right. Adjustments, and notice I took out the traditional PS, and I also added Roth TSP. All right. This is his Roth contributions because we're talking about we have to figure Roth in here because I said Roth counts towards the retirement savings credit. All right. You get 50% of your traditional and Roth back, up to $1,000 for single taxpayers, up to $2,000 for married filing joint. All right, and that's another formula that I put in there. If this number gets to be above 1,000, then just stop at 1,000 because you can't get any higher than 1,000. So, but I'm going to show you why knowing this and being able to plan ahead is going to benefit you. Okay, so let's say Roth is the way to go. It definitely is because I've already paid taxes on this. When I retire, the compound interest that I earn on my Roth TSP contributions will not be taxed. That money is all mine. Okay, and what I pay, what I put in my traditional TSP, I put in before taxes, and I'll have to pay taxes on that and the compound interest that I earn when I retire. So he's making, and this is a good idea. He's not putting anything into his traditional, but he's putting money into his Roth. Not a bad idea. Okay, but let's see what happens. His AGI is at 18,720, and according to the retirement savings calculator, or the savers credit, all right, his AGI is higher than 18%. Or 18,000, so he's only getting 20% of his total contribution. He's only getting 20%. So 20% is six. That's 320. So we're only knocking $320 off of this total tax that he owes, plus $1,000 child credit. So why would it benefit him to not put more into his Roth until he puts more into his traditional TSP? I'm going to show you. So what we're going to do is we're going to add 1% of his pay into his traditional TSP. All right. Well, that reduced his AGI. Roth does not do this. Only traditional reduces your AGI. We add these together, divide them by the multiplier in the for the retirement savings credit, but only the traditional reduces your AGI. So at 1%, his AGI is still at 18,391. At 2%, we're still above that $18,000 threshold. Now watch what happens at 3%. All right, 3%, just 3%. All right, right now his credit is $451. All right, so that's got his taxes owed at $804. If we bump it up to 3%, now his AGI is below 18,000, and he's getting the full 50%. All right, and between these two, he's contributing almost 2,600. Half of that would be 1,300. The max credit he can get is 1,000. So he just, by adding 1%, all right, he reduced his taxes from 804 to 206. All right, that's $398. All right, split up over the month. Well, if you look at it, he's contributing an extra $656 to $984. So he's contributing about the same amount that he's losing, but instead of giving this money to the IRS, he's giving it to himself. All right, the money's going to come out of his paycheck either way. It's going to come out of his paycheck either way. All right, but he has the choice. He can either give this 3% to these guys, or he can give this 3% to himself in the form of TSP payments. So we talk about tax-free income for life, right? So we bump this up, all right? We're going to bump this up to 4%, right? 4%, and then we bump it up to 5%. And how high do we have to go? Maybe 6%, and then 7%. And this number is going to be different for everybody, okay? It's going to be different because, well, not for everybody, but everybody has different exemptions. Everybody has different deductions. You know, some people are married, filing joint. Some people have 2 kids, 3 kids, 4 kids. You know, it's going to be different for everybody. But once you reach the point by adding TSP, strategically adding TSP, traditional contributions, and reducing your AGI below the certain threshold to get the maximum amount of your retirement savings credit. At this point, once you reach the point where the taxes that you owe is 0 or a negative number, at that point, your income is tax-free. The IRS will start withholding or stop withholding federal tax payments from you if you go into the withholding calculator and you do what it says. You put these numbers in and you do what it says to do by increasing your exemptions, like I did with mine. I increased my exemptions to 7 on the IRS's recommendation. They stop withholding. So essentially, this money is tax-free. Well, then what that frees you to do is once you find this threshold, once you find, okay, it was 7, was it 7% for this guy? Okay, it was 8%. Once you find this threshold, okay, 26, 25, 60 over the course of the year. All right, what that does is it frees you up to put as much as you want into the Roth, and that because this money is tax-free now, and because this money comes in, quote unquote, after tax, right? You're not paying tax. So it's coming in after tax. The dividends that it earns, the compound interest over time, when you withdraw this money in your retirement, your Roth TSP contributions that you make now, under these circumstances, are tax-free forever. You're not paying taxes on them today, and you won't pay taxes on them however many decades from now you retire. So that's what I'm talking about when I'm talking about tax-free for life. That it frees you up to be able to put, and you know, it's going to depend on your circumstances. If you got mouths to feed, if you got vehicles to buy, if you got a mortgage or whatever, you put as much into this as you possibly can right now, because tax-free for life. And still, again, this is at $39.59. A $39.59 refund. He's got a kid. He qualifies for an income credit, so he's looking at probably a $1,500 plus this, so close to $2,000. A $2,000 refund, free money. Here you go. This is the subsidize. This is the subsidize your retirement, because it's going to cost us more from the government. It's going to cost us more to pay for you to live when you retire than it is for you to pay for you to live when you retire, and us to give you just a little bit of money for it now. So if you want to go back and watch that again, if you need to, go ahead. Like I said, I apologize for making all these changes. I know I've kind of been going with it with you and showing you how I do everything, but this is just to show you this is exactly what that income calculator does, the income withholding calculator does, that I showed you. That is just about the most powerful tax planning tool that you have, and I'm just showing you the numbers are right in front of you. You can see everything that's going on, why the calculations are made the way that they are, and all you got to do is tweak these couple of numbers. How much am I contributing to my retirement to control what this number is and how your taxes are calculated on it. So thanks for sticking with me. We're going to get into some more good stuff. See you in the next video.